Good morning. Welcome to Bazaar Morning Call. We're live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. I'm Sonia and joining me today are Rima and Nigel. Well, guys, it's Friday.
Friday!
And it's Friday. Both of you are in pink, so that's always good, in the pink of health. But it's a long week, right? It's been a really long week. And Nigel, all ready for Friday?
A really long week. I mean, I was
and we thought last week was long, right? Yeah. This felt equally tiring and exhausting, man.
Absolutely. I mean, last week we were looking forward to the weekend. I think this weekend is going to be much better. I mean, and it's the end of earnings season, almost the end.
It is almost the end of earnings season. Budget is over, earnings season is over, so work kind of slows down. But for today, we've had a sort of a weak handover from the US. So in that context, it's going to be perhaps a gap down opening. The Dow was under pressure, about 250 points gone yesterday. Nasdaq has had the roughest time this week as well, and earnings are not looking good across the US, whether it's the ride-hailing major Lyft or even Expedia. Those stocks were under pressure after very disappointing earnings that came through. For our own markets, though, the interesting bit is that the FI data is very encouraging. In the last many days, FI selling has reduced drastically. There was barely 150 crores of selling yesterday compared to an average of around 2,000 crores last week. So in that context, it's very good. And of course, our own markets, the Nifty has gained a bit of ground. This month itself, in 10 days, the Nifty is up about 1.3% and now is approaching the 100-day moving average of 17,940. Let's see, that could be a little bit of a resistance for the market, given that we have weak global cues this morning. But in general, the market has been sort of climbing higher. So will the market continue to see buy on dips? That's the big question. A couple of things in focus. Of course, the Adani Group stocks will be in focus as the MSCI will be reducing weightage in 4 Adani Group companies effective from the 28th of Feb. Enterprises, Total Gas Transmission and ACC. So those stocks will continue to be on our radar. And Zomato, interestingly, there are so many memes doing the rounds on Zomato's excessive use of the phrase adjusted. But it's a net loss that they continue to post, higher than what they saw last quarter. As well as, of course, the food delivery business has improved for sure. So the EBITDA in the food delivery business is now 20 crores plus versus just about 2 crores. And the gross order value has picked up. So a couple of their businesses are doing well. It's really interesting, all the memes, I mean, fun to read.
Yeah.
Adjusted EBITDA. But let's see how the stock does today. It has been on a bit of an up move. Let's see how the street reacts.
One more thing about Zomato, while they're focusing so much on profitability, the top line, the revenues are actually down 1% on a quarter-on-quarter basis. So, we shouldn't forget that, this is a company which is known for its growth, and their revenues are down 1% on account of a decline in order volume.
Well, point taken on that. In terms of trade setup, Wednesday was a good day because you had central bankers, they didn't give any shocker. Yesterday was weekly expiry as well, and it played out pretty okay because the Nifty ended in the green with a gain of around 20 points. At one point of time, we were down close to around 100 points. The last 2 sessions are good. The big question is today is Friday, and can the bulls go into the weekend on a high? If that has to happen, the Nifty Bank has been quiet in the last 2 sessions. It's not really moved much. While the Nifty is up close to 100%, 170, 180 points odd. So the Nifty Bank needs to find its form and needs to perform if, in fact, we need to battle. We've got a battle on hand because the SKF Nifty is suggesting that we're likely to start off on the back foot with a cut of close to around 100 points odd. The FI is selling, well, that's come down and that's heartening. This week itself, they sold less than 5,000 crores. The last week, we had 1 day of positive inflows. Yet last week, on the whole, they sold close to around 4,000 crores odd. So good to see that they're selling less. In terms of the F&O action, well, yesterday, the Nifty ended mildly higher and the open interest is down by close to around 2%. So some shorts, they're covering out their position. Maybe they're not getting follow through on the downside. Well, on the FI positioning, they continue to remain net short. Short positioning is at around 81%. So if you get any semblance of some good news, that's what could lead us closer to around that 18,000, 18,100 odd mark. Options data are crucial. The bears, they are looking to defend the 18,050 odd mark because yesterday there was a lot of writing at the 18,000 call. On the downside, though, there is some writing that we're seeing at around the 17,800 put. Close to around 63 rupees was, the premium out there. So what are the levels you're looking at? We bounced yesterday from around that 17,770 odd. So the support level becomes important. That's a crucial level. We like to start off closer to that level. So very, very important. The 20 as well as the 100 DMA, there'll be a bit of a resistance on the upside. Well, yesterday we got past the 20 DMA. You like to end closer to around the 20 DMA and make a dash towards the 100 DMA. The Nifty Bank, I said, has to play a role today. The IT index, remember, could start off on the back foot because the Nasdaq was low. And we've seen some bit of a correlation play out there. So for the Nifty Bank, the 41,200 becomes very important because the 41,500 put has been seeing fair bit of writing. On the upside, though, the 20 and the 100 DMA, they have been elusive, and they are at around 41,700. So the Nifty Bank level should come up for you on the screen. We start off on the back foot. Let's see whether or not we can defend the 17,750 odd mark and see a bit of a bounce from the day's low. Rima, what else?
Well, I'm tracking the data coming out of China, right? That was released just a couple of minutes ago. China's CPI inflation has picked up to 2.1%, which compares with 1.8% in the month of December. So this whole reopening has fueled some inflation in China, but the producer price index continues to decline and it slipped minus 0.8%. But broadly, the economists are saying that this is largely in line with street expectations. The kind of upside that we've seen in inflation and the upside surprise that we've seen in inflation across the region is not yet visible in China, which gives the central bank in China some room to be accommodative when it comes to their monetary policy. What will we watch out here in India? You've got the IIP data that's going to be out later today and earnings from M&M as well as ABB and a whole host of mid-cap companies. But before we get started on Bazaar, let's tell our viewers what we've lined up in the first half an hour of the show. We'll get you updates from the markets across the globe. Steve Bryce of Standard Chart, Wealth Management and Cameroon brand of EPFR Global will join in to discuss the global trade setup. Later on, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. And around 8:30 a.m., we'll do a fundamental stock analysis with Gurmeet Chadha of Complete Circle.
Okay, so let's also get you some voices now on the equity side. First up, we have Ridham Desai of Morgan Stanley giving us his view on Friday, saying that India's relative returns remains under pressure due to the recovery in emerging markets, but they expect absolute returns to improve versus 2022. Morgan Stanley's portfolio strategy includes a barbell sector positions with a cyclical bias, a preference for the broad market and stock picking over large caps and macro investing.
Some money market views then. Bhaskar Panda of HDFC Bank says the action-packed week, which saw rate hikes from various central banks, including India, is almost over. Thankfully, the volatility was not as much as most of the action came within script. Oil rally too has tapered down. Bhaskar Panda says the USD INR seems to be in a consolidation phase around 82.5 against the dollar, waiting for a breakout. Today, he expects could be another day of consolidation where the USD INR could trade in a range of 82.45 to 82.65 against the dollar.
All right, and on the bonds, Bhaskar Panda says that the RBI has raised interest rates. That was highly expected by 25 basis points. And the guidance is mildly hawkish. Traders seem to be relaxed, which is reflected in the range-bound movement in yields. He expects the same trend to continue and the 10-year benchmark yield to trade within a range of 7.3 to 7.35%.
Well, we have a lot of stock-specific action for you, to track for you, and we'll get to that in just a bit in our special Top 10 segment. We have Zomato, HPCL, Oro Pharma, Lupin, Indian Overseas Bank, and MTAR Technologies. They are stocks on the back of positive news flow. On the flip side, you have the Adani Group, United Breweries, LIC, and Voltas could open up in the red, reacting to negative news flow.
Okay, so lots of stocks to focus on. Of course, the Adani Group stocks and Zomato will be top of mind. But first up, let's get our first guest on the show. Steve Bryce, who's the Chief Investment Officer at Standard Chartered Wealth Management, joins in. In a bit, we'll have Cameron Brand, the Director of Research at EPFR Global as well. Gentlemen, morning to both of you. Steve, let me begin with you. There were dovish undertones that came through from the Fed, and that has raised investors' hopes that perhaps the worst of the macro downturn is behind us and the worst of the rate tightening cycle as well could be over. Is that your best guess? And if yes, how do you think equities could react to it globally through the course of the next many months?
Yeah, so clearly we think that the majority of the Fed tightening is out of the way. That's pretty clear. The question is, how much more do they squeeze into this before we see actually them go on hold for an extended period? So our central scenario is that we'll see one rate hike. We are skewed slightly to 2 versus 0. So, if we were to see 0 rate hikes, I would peaked already, would be very surprised. But 1 or 2 seems to be what is likely here. But that doesn't, from our perspective, that doesn't mean we're in for a soft landing. I think that the way that we look at the world is saying the yield curve has been inverted alongside a lot of other indicators that suggest the economy is weakening quite considerably, obviously outside the labour market. So from our perspective, the yield curve inversion since mid to late last year suggests the Fed is already tightening too much. It's tightened another 150 basis points since October. And therefore, we are heading into recession. It's just a matter of when does that happen. Our best guess is that that happens around mid-year this year, so not too far away. Of course, the recent data may suggest that could be pushed back a little bit, but overall, we think that the macro environment still, at least in the developed world, is still looking very fragile.
Steve, but contradicting the fact what the US yield curve seems to be suggesting, that is a recession is due, is the jobs data, right, from the United States. Last week, it was exceptionally strong. So how do you marry the two data? Because on one hand, the inverted yield curve seems to be suggesting that a recession is coming in the US, but on the other hand, the jobs data is still very strong.
Yeah, so if you look obviously at the NFP number, as you say, it's extremely strong. But if you look at the underlying data, even from the labour market, now labour market we should acknowledge is a lagging indicator, right? But if you look at the data outside that, you look at the quarterly data, that's been a significant divergence from Q3 last year, actually, which suggests that the labour market is not as strong as NFP itself suggests. If you look at small businesses, which have been obviously the ones that have been hiring the most, you see large cap job cuts on a daily basis. So small enterprises are the key to this squaring the circle, and their intention to hire index has started to weaken significantly as well. So from our perspective, the more forward-looking indicators suggest that even the labour market is likely to slow down quite quickly as we go through this year. Obviously, the question then comes, look, inflation is still going to be above the Fed's target for the rest of this year. So the question is, okay, when do they start focusing on growth and ignoring inflation? We're still some way away from that point. We do expect rate cuts towards the end of this year, but that's not the focus for now.
Okay, all right, Steve, just hold on to that thought. Let's welcome Cameron Brunt as well into this conversation. Hi, Cameron. Good morning. Thanks so much for joining in. Well, how are you reading the flows picture? I mean, the sense that we get an updated number that comes every evening. And that was suggesting that FIs, maybe they're selling a little bit less in the Indian markets. What's your sense on the flows? And, in the last 2 weeks or so, we have some negative news coming in on a particular group, that's the Adani group. Have you seen any kind of flows, either the FI flow is getting a little bit more aggressive? Some color on that. Go ahead.
Right. Certainly what we're seeing is investors not wanting to miss the upturn, but an early conviction that the Fed was barking more than biting has begun to crumble. And certainly this week, the flows have been marked by a great deal of sort of second guessing earlier convictions, which certainly boosted flows through the first 5 weeks of this year.
All right. So, Steve, before we end the discussion, how do you think viewers who are watching you right now, right, an Indian viewer, how should they approach the markets now? Is this a good time to be accumulating, assuming that perhaps the worst of the rate tightening cycle is behind? Do you think the worst of the macro problems in India as well are behind us? And what about the India versus China argument? Because most believe that money is going to move out of India into China. Then what happens with the investment rationale here?
Okay, so there's quite a lot to get into there. So let's just talk about the developed market, so US equities picture to start with. So we still feel against the backdrop of that recession outlook that we have that there's likely to be another leg lower in equities. Obviously, that's been a difficult view to hold on to so far this year because we've seen equities just do nothing but go up. But we do think we're still going to see another leg lower. So we would be waiting on the sidelines for that before adding to equity positions there. On the China versus India, look, I mean, obviously we've seen net outflows from India. You alluded to it in an earlier segment. Last year, we saw net outflows from the Indian market. What's interesting to me is that those flows seem to be ebbing somewhat, despite some negative news flow, right? So from that perspective, it suggests that the need for people to sell Indian equities from an offshore perspective is much reduced. And therefore, we do see stronger returns for the Indian market, but we see even stronger returns from China. Now, we're seeing some consolidation there, obviously, in recent times because of the very sharp rally. So we alluded to this in our weekly report over the past couple of weeks, saying that some sort of consolidation and reversal was likely in China, but the macro picture there still very positive. Inflation data today not suggesting that the authorities are going to have to tighten down on policy anytime soon. So from our perspective, China over India, but India still experiencing a pretty good 2023.
Okay, gentlemen, we leave it at that. Thanks a lot for joining in and have a good day, have a good weekend as well. Let's take a quick break on that note. So many stocks to talk about on the other side of the break. So don't go anywhere. We'll be back in just a bit.
Bazaar morning call. It's a Friday morning. The Indian markets have been consolidating in a range, but the volatility has eased over the last couple of days, and the broader markets have started seeing a lot of buying. So this week to date, while the Nifty is up 0.2%, the mid-cap index is up 1.9%. So the broader market undertone is fairly bullish. And this morning, too, there are lots of individual stocks to track. Our entire research team is standing by. This is CNBC-TV18's list of top stocks to watch for the day. Mangalam, the big one to watch, the most talked about, Zomato. How are the numbers?
Most talked about indeed, and the new age businesses invite a lot of opinion as well as discussion and memes, etc. on social media. But let's stick to the basics here. The results versus what the street was anticipating. Revenue grew 17% quarter on quarter. ISEC was expecting a 6% growth, so it's a beat out there. Food delivery gross order value was slightly slower in growth as against expectations, but then again, EBITDA loss was narrower than what the street was anticipating as well. Contribution margin of 5.1%, bang in line with CLSA estimates, and even the food business margins at 2% in line with CLSA's estimates. What is good is that their food business EBITDA came in at 23 crores versus 2 crores quarter on quarter. The company's maintained its adjusted EBITDA ex-Blinkit positivity by Q2 FY24. This is something that they've reiterated, and they are targeting 4 to 5% of gross order value as medium-term EBITDA target as well. What's not good is that there is a slowdown industry-wide, and this happened post-Diwali. In fact, revenue declined by 1% quarter on quarter, and for that itself, the company will have to invest in Zomato, Gold, etc. to support growth further. Blinkit, while the revenue grew, we did see an EBITDA loss of 205 crores out there as well. On that, the company believes that the things are improving. They can grow their dark store network by 30 to 40%. And at the same time, in the food delivery business itself, they've exited about 225 stores to maintain their profitability. Plus, they have cash on books of around 11,300 crores, which is about 25% of their market cap. My sense, the stock may see some green because revenue and operational performance is better than expectations, and the cash provides its support.
Okay, thanks a lot for that. It would be most interesting to see how the stock reacts today. Goldman Sachs put out a report where they said that in the near term, there is potential pressure on their profitability because of the reasons that Mangalam was mentioning, the dark store expansion as well as the launch of Zomato Gold. So let's see, this one's going to be a good one. But from food, let's move to drinks. Surbhi is here to tell us how United Breweries look this time around. Surbhi, over to you.
United Breweries reported a very weak set of numbers. The revenue growth was muted only 2% on a year-on-year basis. The sharp inflation in glass and barley prices have led to a gross margin contraction of more than 800 basis points. This has also led to a 56% decline in their EBITDA, with EBITDA margins contracting almost 700 basis points. PAT before their exceptional item was at 31 crores, down 66%. Now, the company has booked 33 crores as impairment charges on their Andhra Pradesh and Tamil Nadu plant and equipment, which is implying that the company is not expecting sharp sales recovery from these states. Now, analysts estimate the volume growth for this quarter is 4%, and that is impacted by the sales in the states of Andhra Pradesh and Tamil Nadu. Given a massive miss in their estimates, you can expect the stock to be under pressure today.
Wondering how that happens, Surbhi. Anyways, we'll expect that stock to open up in the red. United Breweries, a disappointing set of numbers. Well,
maybe people are getting healthier, maybe.
Maybe we didn't do our bit. Let's go across to Sonal. Sonal, HPCL numbers are good.
Oh yes, they were. It was a beat and surprisingly led by their marketing segment because HPCL has more exposure to that particular segment. Now revenues, they were flat at 1.09 lakh crore rupees, absolutely in line with estimates. The company reported an EBITDA of 1,277 crore rupees. This compares with a loss in the quarter gone by and higher than estimates of 921 crore rupees. Profits also came in at 172 crore rupees versus a loss, and the expectation was of a loss as well. So definitely it's a beat on the bottom line as well. Refining margins, however, were lower than estimates, $8.9 per barrel versus estimates of $13 per barrel. But as I said, it was a marketing-led beat. So marketing sales was up 6.7% on a YOY basis, 8.5% on a quarter-on-quarter basis, and it was higher than what the street was working with. ICICI Securities says they're estimating that marketing losses have contracted sharply. They have come in at 1.6 rupees per litre versus 7 rupees per litre in the quarter gone by. Jeffrey says yes, that Q3 was ahead of their estimates, but they will revise their estimates only if there is some clarity in terms of 30,000 crore rupees allocation to all marketing companies in the budget, what really it means for these companies. But yes, it was a beat as far as Q3 numbers are concerned.
Thank you very much for that. Let's find out how LIC's numbers look. Surbhi joins in with the details. Surbhi.
LIC reported their Q3 numbers and they don't look so exciting. Remember, these numbers cannot be compared on a year-on-year basis, and when you look at the numbers sequentially, they don't look too impressive. For Q3, even though their individual APE is up 7%, the total APE is down 18% at 12,317 crores. The value of new business, that is down 20% sequentially, and the margins are marginally down by 60 basis points. On a 9-month basis, the new business premium is up 8%, the gross premium is up 21%, and the AUM is up 11% at 44 lakh crores. More importantly, their market share in policies is down 2%, which is a little concerning. The number which is not declared this quarter is the embedded value. Even though the management has indicated a good growth in embedded value for FY23, that remains an overhang for the stock, because remember, life insurance companies are valued at price by embedded value. The con call is scheduled this morning, so we will get more commentary from the management, but for now it's a muted performance by LIC.
Thank you very much for that. Not done just yet. We've got pharmaceutical stocks to track. Ekta joins in. Ekta, how did Aurobindo Pharma, Lupin, and you're also looking at IOB?
Well, yes, it's definitely a mix this morning. I'm going to start with the two big ones in the pharmaceutical space. Aurobindo, where the revenue was up 6.7%. The street was estimating a flat growth, so that's better than expectations. Margins improved to 14.9% versus 13.8% Q-on-Q, and versus estimates of around 16%. Profit also came in at around 491 crores. That missed expectations, but the street is going to be looking at two factors: the margins, which have improved, as well as the US revenue, which is coming at $366 million versus estimates of $350 million. The board is also going to be transferring their API non-antibiotic business via slump sale worth over 3,300 odd crores to a wholly owned subsidiary. So the street will watch out for what the rationale is behind that. Now the call is at 8:30 a.m. Lupin, margins at a 5-quarter high, US sales at a 3-quarter high. India is a single-digit growth for the second consecutive quarter, so that's probably a bit of a dampener. But revenue up 4%, margins 12.3% versus estimates of around 12.2%, so bang in line, and profit of around 153 odd crores. And there's a sequential improvement in margins, which the street will like. US sales better than expectations, $177 million versus estimates of $165 million. So that's definitely going to be a positive. Now moving to the banking space, IOB, NII, which was up 44% year-on-year. Profit, which was up 22% year-on-year. Net interest margins have improved as well to 3.27%. Gross NPA ratios as well as the net NPA ratios are better. So I expect all three of these stocks to possibly be in the green. Aurobindo, remember, also depends a lot on commentary.
Okay, we'll watch out for the commentary from Aurobindo. Thanks a lot for that. But by far, the most important stocks to watch today could be the Adani Group stocks after the MSCI rejig that will take place. Vivek is here to give us the fine print. He's been on top of that story since day one. Vivek, over to you.
Well, good morning. Well, what's actually happened is that the uncertainty has now given way to quite a bit of clarity as to how exactly the Adani Group stocks will be treated as part of the MSCI Global Standard Indices. So, out of all of the Adani stocks that are part of the MSCI Global Standard Index, in this particular review, there will be a slight weight decrease as far as 4 of the names are concerned. So, like we highlighted, the top 3 names that had the highest weightage within the MSCI Standard Index, which is Adani Enterprises, Adani Total Gas, and Adani Transmission, will see a weight decrease today, and these changes will be effective from Feb 28. So as per analyst estimates, Adani Enterprises expected to see an outflow of close to $185 million, Adani Total Gas expected to see outflow of close to $125 million, and Adani Transmissions expected to see outflow of a little over $165 million. So the stocks continue to be a part of the index. In this particular review, the weightage has been decreased, and it is now, we'll have to wait and watch whether in subsequent reviews there is a decrease or whether whether there is a deletion of the Adani Group stocks. It will largely depend on the stock price performance. Along with that, Adani Total Gas also has declared its results. It's a largely inline set of numbers with a slight increase as far as the profitability is concerned.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Vahista. Vahista, you're tracking a few numbers. Voltas look disappointing, right?
That's right, Nigel. Of course, another quarter of disappointment for the company. Revenues up 12%, but margins have dipped to 3.8% versus 8.8% in the same quarter of last year. And due to some provisions of 137 crores, the bottom line has turned negative in this quarter. Now, moving on to Voltas' biggest segment, which is the unitary cooling products division. Given that Q3 was anyways a lean season for the cooling products, the revenues from this segment have grown by meager 11% versus its peer, Blue Star, whose UCP division revenues grew by 15%. That's point number one. Point number two, another negative has been a fall in profitability for the UCP segment by 13% on a year-on-year basis. And the last and most important point, the market share, the room AC market share has again dipped. Forget about maintaining the existing market share. It has dipped further to 22.5% as on 31st of December 2022. While we compare it with 31st of December 2021, it was at 25.9. So that's a sharp dip. All in all, there are more negatives than positives in the result, and hence I'm going with a red on the stock. But another stock which also released their results yesterday post-market in the defense space has been MTAR Tech. Good results, revenues have doubled, and order inflows are up 41% on a quarter-on-quarter basis, which has come into excess of 800 crores. Back to you.
Okay, thanks a lot for that. So we'll watch out for MTAR Tech on the upside and Voltas on the downside. In case you missed out, here's a quick recap for you. Stocks with positive news flow today. There's Zomato, there's HPCL, Aurobindo Pharma, Lupin, Indian Overseas Bank and MTAR Tech. While stocks with negative news flow, there's the Adani Group, United Breweries, LIC and Voltas. But let's also find out what's happening in the world of commodities. Brent crude has been inching up higher in the last couple of days. But what's the latest today? Manisha Gupta is here with all the action. Manisha, good morning.
Morning, and thank you for that. Well, after 4 days of gain, we've seen some bit of a decline come in for the crude oil prices. The percentage point decline is how we closed the overnight market. This is after the U.S. crude stocks have risen to the highest since June 2021. While there is recovery in global demand, and that would be supportive, and so will the case that there are shutdowns in Norway and Turkey, is the reason you're still holding above $84 per barrel for the crude oil prices. What has seen a sharp decline, though, has been the precious metal prices. 1 month lows for gold prices now, and this is headed for a second weekly decline for gold and silver both. The US dollar index seems to be finding a bottom, and rising short-term yields also are weighing onto the markets. And within the base metal prices, it is copper, which is the top favorite. So even as the other metals have been choppy, copper prices continue to trade firm today in Asia as well.
Manisha, thank you very much for that. Need to slip into a very short break. We'll come back and discuss more stocks. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, will join in.
Good morning, call. Hope you're having a good morning. Well, for starters, the bears will be quite thrilled because the Nifty is likely to start off on the back foot with a cut-off close around 100 points. Can we bounce from there? Well, time will tell. For the time being, though, 17,750 is a crucial support zone. But time to get chatting about plenty of stocks. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, joins us on the show. Hi, Gurmeet. Good morning. And, Anuj is in Delhi, so I think you'll be treating him to some of that chole bhature if I'm not mistaken. Make sure to pack some and send for us as well. But, Gurmeet, let's talk about a few stocks. We'll get to the new age themes in just a bit. But LIC, the big IPO, it came, it drained out a lot of money from the market as well. The numbers looked a little bit disappointing. What's your view at current reckoning?
So Nigel, I think where they are probably missing out is on the VNB margin, and that's got to be do with the proportion of non-par products they have. Well, it's gone up to 10% now, but it has to go up, and bulk of the profit actually came from the transfer to the shareholder fund. But if you see in terms of net premium, I think they continue to do well, almost 14.5% kind of a growth. In terms of number of policies issued, for 9 months, they've almost issued like 1.3 crore policies. So their market share has actually improved to 65%. And at probably 0.6, 0.7 embedded value, a lot of it probably is in the price if you compare. Despite the fall in private insurers, they traded like 3 times, 2.5 to 3.5 times embedded value. So my sense is as the proportion picks up, and there is some negative news around the investments in Adani Group also, which in my view is a little overrated on the stock. I think that's the reason it's been under pressure. But the price performance is already subdued. I don't see any incremental impact per se.
Okay, Gurmeet, hi, good morning. What about all the memes on Zomato? That was quite entertaining, right? In the last 12 to 18 hours. But on the stock particularly, I mean, you know, everything said and done, there is a path to recovery that you can see, right? I mean, the food business is growing. The EBITDA over there is much better than what we saw last quarter. And overall, it looks like things are on the mend. Is a risk reward favorable for a Zomato investor now?
First answer is I don't know. I agree with you. You know, the food economics is improving. In fact, what I was happy in the result, the one thing was the contribution, right? Which from on the food GMV has gone up to 5.1%. This like 21, 22 rupees an order. Used to be like 17, 18 earlier, used to be like 15 bucks. So that they are continuously improving. So their focus now on profitability, I think, is heartening. I think that point is well taken. But on other businesses, which is your Blinkit, Hypershore, you know, again, if you go for growth, you incur more losses. If you start chasing profitability, then, you know, the GMV and all comes down. It's a tricky situation. And, you know, I don't honestly like these terms on EBITDA minus this, minus that, EBITDA adjusted for that. I think I'm happy to join the party late when I see EBITDA net of everything being positive.
Well, it was anyway adjusted EBITDA, and now we're looking at an adjustment to the adjusted EBITDA because now it's going to be seen as ex-Blinkit. But Gurmeet, hi, morning. What are your thoughts on Page Industries? Well, numbers came out yesterday and surprisingly very weak. Volumes down 11%. The sales were flat after 8 quarters of a double-digit top-line growth. This is an expensive stock. It trades at 45, 48 times forward multiple FY25 PE, and even the EBITDA is the lowest in a non-COVID hit quarter in more than a decade. And even the management commentary in the conference call yesterday seemed to suggest that competitive intensity is picking up in athleisure, very lukewarm on demand recovery. Your thoughts on Page Industries and what we've seen?
No, agree with you. In fact, you know, our family distribution has been, you know, we've been distributors of Jockey, you know, in my hometown. But so, you know, so I think what there's a heightened competition at the ground level with a lot of competing brands now. I mean, and there's so many brands which are in the unlisted space, and Jockey had that exclusivity at some point of time. Also, I think their market share in women's segment hasn't grown the way their investments have and the focus have. So they actually do more in the women's segment than in the men's segment, almost double of that. And then they've been trying to get into, you know, athleisure, which has been a little patchy. Some quarters shows uptake, some shows downtake. And in these kind of markets, you know, you can't afford to disappoint if you are at such a high multiple. We've seen that with so many stocks across the market caps. When interest rates are high, you know, there is very little margin for error. So my sense is that I would tend to stay away. I mean, there are better stocks in this particular space. Textile overall sector, there's a lot of opportunities, you know, with, you know, focus of government, others. Maybe you can leave this segment aside. Not really textiles, I would say, this segment, but there are better opportunities like Gokuldas, like some of the other PLI benefiting sectors where there could also be some FTA with UK, which could be in focus. So there are better opportunities in that space.
Okay, all right, Gurmeet, I request you to just hang on for a bit. We're coming back to you. For the timing, let's focus on SKF India. Well, the numbers are pretty much in line, the bearings player that is. We have Mr. Manish Bhatnagar, the MD at SKF India, who joins us on the show. Hi, Mr. Bhatnagar, good morning. Thanks so much for joining in. Well, what surprised positively was the gross margins. They've come in much higher than, you know, the averages that we've seen in the past. I think it was around 41% odd. What caused this? Was it the product mix? Was it the price hikes? Localization, what was it? If you could give us some clarity on that front. And what do you end this year with? At the 9-month mark, you're closer to around 3,200 crores odd. Somewhere in the vicinity of around 4,500 crores?
Yeah, well, the first part of the question, why were the margins so good? A combination of everything you said. And localization, that's been our strategy for a couple of years now. It's playing out rather nicely now. Clearly, the margins on manufactured products locally are better than traded products. So that's helping us. But also, more importantly, price realization of price increases. We've been able to offset a lot of the inflationary pressures by talking to our customers and making sure we get the price realizations we need. And of course, there's always a deep focus on cost controls. Nothing has changed on that over the years. So a combination of many factors getting us there. To the second part of the question, I don't want to give any forward guidance for sure, of course, but I think what you saw in last quarter would be our trajectory going forward.
Okay. So can you tell us a little bit about the auto segment? Because over there you have a large presence, whether it's in auto replacement demand or even in the two-wheeler space, which has seen a slowdown. I mean, we haven't seen any major recovery in the two-wheeler OEMs, especially the ones that have an exposure to the rural markets. Are you facing any challenges there? And what kind of growth do you see for your own business from the auto segment?
Just to clarify, auto is a large part, but it's not more than half our business. So we are half automotive and half industrial. But specifically on automotive, the half of our business, yes, two-wheelers has been a slowdown, not been a great story last 6 odd months, partly because of inflationary pressures. We've seen two-wheeler prices go up 10, 15%. And the two-wheeler buyer, unlike, let's say, a car buyer, is possibly much more impacted by inflation. So they would either delay their purchases or maybe buy a second-hand vehicle, etc. So two-wheelers, we are seeing a slowdown, like with every other OEM in the country. But on the other automotive segments, commercial, passenger, tractors, we are seeing really good growths. And because we are so well diversified, the two-wheeler slowdown in a way is kind of offset by the growth in the other segments.
But don't you think that because of the slowdown that you're seeing in the two-wheeler space, it could restrict the overall growth that you're looking at? I mean, you're still sitting at about just about making it to the double-digit growth mark, especially in the quarter gone by. So do you think that this slowdown that you're seeing in some of the pockets in the auto segment could restrict your overall growth? And if yes, what could it be in FY24?
Yeah, actually, we are over double-digit marks. We were 11% growth over last year. But none of our segments is so huge, frankly, that it will impact our business. So even the largest segments are about 7, 8, 9%. And the whole point of being a very well-diversified company is that if one segment goes down, so yeah, two-wheelers are slowing down, but industrial, which is 50% of our business, is doing extremely well across segments. So yes, there's a concern on two-wheelers for sure, but not something that I would lose sleep over.
Can you talk a bit about exports? Because you've refrained from growing your exports aggressively, unlike what you're doing in the domestic market. Could you talk about the game plan there? What is it that you're seeing in the export market and why this strategy?
We are very clear. We are not an export-driven setup in India. We want to focus on the domestic market, lots of opportunities here, and we've been consistent in saying this. Exports is about 7, 8% of our total business. We use exports sometimes to support other SKF factories around the world when they have production challenges. But we don't really have sales teams out there chasing exports. And the most important reason is that bearings, we believe, is much more a localized play than an exports play. Customers, very often, we gain share by promising customers availability and reliability as close to their factories as possible. I don't think there's a big play for us to make from exporting from here to the US or here to Latin America or here to Europe. Customers there would much rather prefer nearshoring of manufacturing. So that's why we have not focused on exports from India, and domestic is our focus.
Just getting back to the point about margins, this quarter's margins at 17% is lower than Q2 margins of 20%. You said margins will sustain at 17% going ahead in Q4, or can it get back to the 20% mark?
No, maybe a little higher.
Q4 margins better.
Yeah, 17, 18, 19 is where we think we will be. 17 is the lower end, maybe 19, 20 is where we should be.
Okay, all right. So we've got the margin band from you. A quick question, what about market share? I believe the Chinese bearing companies, again, they have started exporting. Any kind of impact to y'all as of now, or you're seeing that as no impact? What about your current market share? If you could tell us, the verticals that you function.
Yeah, so we have our own estimates of market share. Unlike some other industries, we don't really have third-party data on that. We think we're about 20 to 23% market share. But the Chinese impact on bearings, or in general imported bearings into India, is not so much on the OEM space, for the reason I talked of earlier, the export example I gave earlier. So the Chinese or the imported bearings mainly play in the low-end aftermarket.
Okay.
And because the OEMs, frankly, don't want to take a chance because it's a small part of their product, but it's a very important part. Product would fail with a bad bearing. So they don't really want to go in for that cheaper bearing just to save a few pennies here.
So you're not experiencing any kind of impact to the businesses that you all function in for the reason that you're giving us. That's good news. Very quickly, you said Q4 will be as good as Q3 maybe. On the revenue front, so you're doing around 1,100 crores per quarter. At peak levels, so I'm guessing you end this year closer to around, 4,300 crores at least. At peak levels, you all have done some capex in the past. What is the revenue potential of the company?
Well, the potential is as large as the market is. We are 22% market share right now. Multiply that by 4.2 times, and you get the total potential of the company. That's what we aim for. Of course, we want to, of course, get there. But I think our capex plans, what you mentioned, is about 200 odd crores every year. And really, that capex is aimed at localization. And with that localization, we hope to gain share. We're right now 22%, maybe 23, 24, 25, but anything in the mid-20s would be a good number to aim for.
Are you seeing any traction from the railway segment? I'm asking because the government is, going big into this segment in terms of investments and potential there. Anything that you gain out of it?
Big gains for us in the railways, mainly on the freight segment. The big investments coming are in freight, not so much passenger or metros. So, and we now have our bearings qualified for local freight wagons. And
Can you quantify it for us what the amount could be?
For railways, it's about 8% of our total business.
Okay, all right. We leave it at that. Thanks a lot for joining us. Appreciate your thoughts and your business as well. You've done a lot for shareholders in the last many years, so hopefully that could continue. Gurmeet Chadha is still with us. Gurmeet, this is a stock. It has good amount of institutional ownership. Of course, the volumes are on the lower side. And I think in 2 years ago, the stock was sub 2,000. Now it's, 4,000 plus. Do you think there's more scope here for investors?
So a very, very steady performer, as you said, consistently been good balance sheet. I mean, if you see their ROEs and all, 18, 20%. Also the diversification, so you made that point on railways and this auto and industrial is equally done. I think they're also doing a lot of work on other than bearings on, R&D on this rotating equipment performance products, which has traction largely industrial, again in auto. So I think steady, but it's just that the valuations are slightly on the higher side, about maybe 35 times forward. So it's not radar, but the old favorite continues to be Minda. I think the numbers are very good. Management was there yesterday. CFO was talking to you guys. I think what I'm impressed is that a lot of new segments contributing. So lighting business doing very well. EV or is almost 800 crores now. Alloy wheels picking up pretty well. They spoke about airbags adding 800 crores. So if you have 4 or 5 segments doing well, I think that probably gives you better growth. And again, relative, in this space.
Gurmeet, do stay on. We need to slip into a very sharp break. The SGX Nifty is still down 100 points. That's 0.5% lower, mirroring the weakness that we are seeing across the Asian market and the fall on Wall Street overnight. Get into a break. On the other side, we'll be closer to the pre-opening rates. We'll also invite Shrikant Chauhan of Kotak Securities. This is Bazaar Morning Call. And now let's go across to Anuj. He joins in for a setup on the markets and how we are positioned. And he's joining us from Delhi. Hi, Anuj.
Hi, Rima. Good morning. So it's Friday, obviously, and the global picture is turning a bit murky, especially the way the US bond yield surged in the last hour. But our market has been trying to sort of negate that. And every time there's a dip, it's been bought. And the Nifty has been trying to close above the 20-day moving average. But essentially, it's still a market in which there's buy on dip and sell on rally, which both working. For today, I'll keep an eye on whether we'll have a repeat of what happened yesterday in terms of the recovery being led by the IT stocks. Because, for 2 days now, the Nasdaq has fallen and it's now hit 10-day exponential moving average. That's where it bounced back from last time. And Nifty IT is just about 600 points lower than the 10-day exponential moving average. So if we get there, my sense is you will see a bounce. So that's why, that's something I'll keep an eye on. On the Nifty, the best trade today, according to me, is to play yesterday's range, which is 17,779 on the downside and 17,917 on the upside. And a buy trade could play out if, again, the Nifty IT starts to sort of recover and starts to lead the market. On the bank nifty again, yesterday's range 41,250 to 41,650 is something that traders should smartly play up in today's trade.
Okay, all right, Anuj, thanks so much for market setup. But Anuj, before you go, congratulations. You have powered the team ahead on CNBC Awaaz. Fantastic performance. I mean, dual role on budget day, and it's going to be a fantastic weekend. Your team is totally pumped up here in Mumbai, and I'm definitely going to join the celebrations, Anuj. Full marks.
Absolutely, Nigel. Thank you so much. And, I firmly believe a leader is as good as a team. And I have the privilege of leading a very good team. And, they just showed it, what it is to really outperform on a big day. And, and from the bottom of my heart, I'm thankful to all the viewers, to everyone. And hopefully a stepping stone for bigger things to come.
Of course, bigger things, better things. Anuj, congratulations. But you know what? The only reason we're congratulating you is because we heard there's a big party here in Mumbai. So we're going to be a part of that as well. We're going to miss you. I hope there's a separate one coming for us.
Please join. Please join.
Absolutely.
No, they will. I told you last time also. I told you, Sonia, that you guys have to plan it. I am always there. You have to just plan it. I'll be there. You tell me the time and date, and I'll be there. Now, you guys have to plan it now. And of course, you can join today's party. That's something that I can tell you.
I'll get down to that, Anuj. But congratulations and good weekend coming up for you and team as well. Well, time to move on then. Let's get in Mitesh Thakur, who's joining in, and Shrikant Chauhan as well. Good morning, gentlemen. Mitesh, you go first. Tell us your call on the index as well as fill us in with your stock picks.
Morning, Nigel. So I think on the index, we've been mildly looking at trading upsides, basically, while we maintain that it's a range-bound market. But broadly, we were looking at a test of around 17,980 to about 18,000. With today's gap down, I think that may not happen, and we might actually head towards the lower end of the range, which is closer to about 17,700. So still a market which is broadly chopping, consolidating, but with outperformance coming in from mid caps, small caps, as well as IT stocks.
Okay, Shrikant Chauhan is also with us. Shrikant, good morning. You think this market that has inched up, I mean, it's up 1% this month already. You think it's inching up higher? And if yes, what are the individual stocks you're looking at today?
Good morning, Sonia. Good morning, Nigel and Rima. I think, the markets are going to stay in the range. The overall setup is still indicating us that we are not going to leave the range so easily. 17,700 is certainly going to act as very good support for the market. And if we see any lower opening somewhere close to 17,800 as Singapore Nifty is indicating, then there we should look for adding some long position. The reason is because Nifty IT index, Nifty FMCG, Nifty metal, they all are rebounding whenever there is a fall in the market. So maybe in the near term, I think the market is like preparing to move towards the levels of 18,000. And yesterday's formation was very clearly upward continuation formation. But because of weakness in the US markets, we are going to see the lower opening. So the strategy should be to look for adding long position if we see the market is dropping to 17.8 with a stop loss at 17,750.
Okay, what about individual stocks? Mitesh, good morning. What are you looking at? And what are your thoughts on some of these names like Zomato?
Good morning. So I think, I have today a mix of buy and sell calls. But yes, there is some, with that Paytm announcement, I think there's some clear traction happening in the new internet stocks. And Zomato is now showing signs of bottoming out. I think, if you check the weekly charts, on the 29th of July, we got a closing of 46.80. And then on the 27th of January, we got a closing of 47. So it's basically making a possible double bottom. We haven't got full confirmations yet, but I think the early indications suggest that if this works out, then we should at least see a rally to about levels of 72, 73, which was the recent high, which the stock made in November, and then maybe even more. So quite positive over there. I think the overall setup is turning good. Coming to my stock picks, as I said, mix of buys and sells today. Infosys is a buy with a stop at 1594, and I would look at a target of 1650. Broadly, we've been recommending IT stocks, and Infi comes on the list today. The other buy is Canfin Home Finance. Keep a stop below 588 here, and in the short term, look for a target of 625. Okay. I also have two sell calls. Right. So I'll just continue. Yeah, IEX is the first sell call. Keep a stop at 137.5. Look for a trading decline to about levels of 130, maybe below. And the other one is Page Industries. Big breakdown yesterday. Very negative candle. I think they should see more continuation. Stop at 38,250, targets of 37,000.
Got it. All right. Shrikant, what about you?
Yeah, I would like to go with specifically Bank of Baroda, because there we are seeing continuation formation. It was around 145 levels some few days back. From there, all the way it recovered back to 170. Today, there is news flow, but the formation is also indicating us that the stock is heading for at least 180, 185. So it's a buy at current levels with a stop loss at 164. And the other stock on which we are bearish is Hero Motors. It is finding resistance at higher levels, but at the same time, it has formed lower top formation on daily and weekly basis. So based on it, we are expecting Hero Motor is heading towards the levels of 2400 or 2450 in the near term. It's a sale at current levels with a stop loss at 2580.
Okay, thanks guys for that. We'll take a quick break. On the other side, we'll have the pre-opening rates. Also, a big management coming up. Satish Pai, the managing director at Hindalco, will